Welcome back to The Explainer. So let's dive right into what is basically a massive financial superpower hiding in plain sight right within the IRS code. It's a tool businesses use literally every single day, yet for most of us, it sounds like an incredibly dry, boring accounting term: cost recovery. But I promise you, once you really understand how this works, it's a total game changer. You'll honestly see the business world completely differently.
To see why this matters, we have to look at a genuinely fascinating question raised by data obtained by ProPublica, an investigative journalism nonprofit. They dug into some proprietary IRS data and found some seemingly upside-down realities about tax rates. I mean, how on earth does the owner of a major sports team end up with a functionally lower tax rate than the person pouring beer at the concession stand?
Well, the answer actually lies in how these teams are valued. As ProPublica reported, up to 90% of a sports team's entire value is wrapped up in intangible assets. We're talking things like TV rights and player contracts. Under the tax code, these assets are amortized and deducted over a 15-year period. So the ultra-wealthy are using this concept of cost recovery to legally turn massive financial profits into huge on-paper tax losses.
Which brings us back to our core concept. Cost recovery isn't just dry math, right? It's a strategic toolkit to optimize your tax bill by writing off large asset purchases over time. You see, the IRS realizes that businesses actually need to buy things to operate: buildings, equipment, patents, things that naturally wear out or lose value over the years. But rather than letting a business just write off a huge expense all at once in year one, the tax code usually requires them to recover that cost slowly over the life of the asset.
Now, the exact method you use depends entirely on the type of asset. Personal property, like trucks and machinery, and real property, like buildings, use depreciation. Invisible assets, like patents, use amortization, and natural resources use depletion. So whether you're a local startup buying office chairs or the publicly traded timber company Weyerhaeuser holding $11.6 billion in timber subject to depletion, the rules follow this exact same framework.
All right, here's our playbook for today. We just hit the cost recovery secret, so next we'll master MACRS depreciation, fast track with some special rules, tackle luxury cars and listed property, and finally look at the magic of amortization.
Let's start with part 1, mastering MACRS depreciation.
To really ground these invisible rules in reality, we're going to follow the story of a guy named Esteban. So picture this. Esteban is huddled in a wet sleeping bag in a dark snow cave in the Grand Tetons, just waiting for a massive storm to pass, when boom, he has an absolute epiphany for a better ice climbing tool. He eventually quits his sales job, goes all in, and buys a $275,000 warehouse and a bunch of machinery in Wyoming to start his business, Teton Mountaineering Technology. Now, to legally write off all those new assets under MACRS, Esteban literally just needs to follow a simple 4-step IRS checklist. First, he determines his original basis, basically the cost to buy and prep the asset. Then he picks his depreciation method, the IRS-mandated recovery period or the life of the asset, and finally, the depreciation convention, which dictates exactly how much he can deduct in the very first and last years.
The best way to think about standard MACRS is like slowly draining a pool over a set number of years. Esteban can't just deduct his whole $275,000 warehouse right off the bat. According to the IRS, a non-residential warehouse takes 39 years to drain. Light trucks take 5 years, and office furniture takes 7 years. So he just gets a little bit of tax relief each year as the pool slowly drains.
Okay, moving right along to part 2, fast tracking with special rules.
But let's be real. What if you don't want to wait decades to drain the pool? What if your business needs the cash right now to reinvest and grow? Well, to stimulate the economy, Congress actually gives us 2 massive shortcuts. Section 179 acts as a targeted lever. You can pick and choose specific assets to expense immediately, up to a strict dollar limit. Bonus depreciation, on the other hand, is just a massive sweeping percentage deduction. For 2024, it's set at 60%. And get this, there is absolutely no maximum dollar cap.
Just to give you an idea of how powerful Section 179 is, $1,220,000. That is the maximum expense a business can immediately deduct in 2024. It essentially opens the floodgates for immediate tax relief for small and medium-sized businesses buying machinery, computers, delivery trucks, you name it.
By smartly combining these 2 rules, Esteban can completely fast-track his tax deductions. He pays far less in year 1, meaning he can reinvest all that cash right back into Teton Mountaineering. But there is a catch. If Esteban places more than $3,050,000 of property into service during the year, that Section 179 limit starts to phase out dollar for dollar.
See, it's specifically meant to help the little guy, not the mega corporation.
Which brings us to Part 3, luxury cars and listed property.
Now, the IRS is pretty smart. They know business owners might try to sneak some personal items into these deductions. Certain assets naturally blur that line between business and personal use, things like cameras, laptops, and cars. Let's say Esteban buys a $4,000 digital camera. He uses it in his design studio during the week, sure, but he also takes it out for his weekend photography hobby. He calculates he uses it 75% for business and 25% for personal fun. Well, the IRS says he can only deduct that 75% business portion. Fair enough.
But here's where it gets really interesting. There is a massive danger in playing games with listed property. If Esteban ever starts using that camera more for weekend trips and his business use drops to 50% or below, a tax trap literally springs shut. He faces forced recalculations and must retroactively restate all past depreciation using a much slower, straight-line method. He might even have to recognize ordinary income to pay back the excess depreciation he already claimed. Yikes.
And you know, this exact same logic applies to luxury automobiles. The IRS wants to let businesses deduct ordinary and necessary expenses for sure. But they draw the line at subsidizing Ferraris and Porsches on the taxpayer's dime. It's quite the showdown. A $19,150 Honda Civic can be fully depreciated in 6 years, following standard rules. But a $130,000 Porsche 911? That hits strict annual luxury auto caps. Because the yearly deduction is so severely restricted, it will actually take the business 15 years to fully write off the Porsche.
And finally, Part 4, the magic of amortization.
Okay, let's tie this all together and see how this connects back to those Wall Street billionaires from the beginning. While physical assets use depreciation, invisible assets use amortization. This is just the tax method of recovering the cost of non-physical intangible assets, like patents, goodwill, or non-compete clauses evenly over a set period. And folks, this is where the biggest tax magic happens when businesses are bought and sold.
So let's look back at that 2019 ProPublica data. Steve Ballmer, owner of the LA Clippers, had a federal income tax rate of 12%. LeBron James, the star player, paid 35.9%, and a Staples Center worker paid 14.1%. Now, we are strictly just looking at the mechanics of the tax code here, but it's absolutely vital to understand how the owner mathematically achieves a functionally lower tax rate than both his star player and his stadium worker.
The owner accomplishes this through Section 197 of the tax code. When a franchise is acquired, the huge purchase price is allocated to its assets. And remember what we mentioned earlier? Up to 90% of a sports team's value is wrapped up in intangible contracts. Section 197 dictates that these purchased intangibles must be amortized perfectly over 180 months, which is exactly 15 years, regardless of their actual stated life. This legally generates massive, totally predictable paper losses every single year for a decade and a half, which the owner can use to offset other income.
But here's the wild part. Ultimately, the rules of the game are played on the exact same playing field. Whether you are Esteban taking MACRS depreciation on a $25,000 delivery truck out in Wyoming, or a billionaire amortizing a professional basketball team in LA, you are both fundamentally executing the exact same tax strategy. And believe it or not, you are filling out the exact same paperwork, IRS Form 4562. So from a wet sleeping bag in the Tetons to a massive corporate sports empire, cost recovery really is the invisible engine of business growth. Understanding the nuts and bolts of basis, MACRS draining the pool, Section 179 fast-tracking, and Section 197 amortization takes what seems like a totally dry tax obligation and transforms it into your absolute most powerful strategy for retaining capital.
I really hope this explainer opened your eyes to the true power hidden within the tax code. The tools to optimize your growth are all right there, perfectly legal and just waiting to be utilized. But at the end of the day, it's entirely up to you to decide how to play the game. Thanks for hanging out, and I'll see you next time.